Hey everybody, welcome to today's video, Easy Funding Your Airbnb. Let's jump right in. So in today's video, we're going to talk about what is a short-term rental. And remember, in these videos, we're always talking from a lender's perspective using their definition because we're talking about how do we get the money to purchase or to refinance a short-term rental. And in this case, you guys probably know them as Airbnb properties. We're going to get into further definition. We're going to talk about who writes these loans, how to qualify, secret pro tips, and how to get started right away. So if you've got a property you're looking to purchase, you're looking to refinance, you just want to get into the business, you just want to know a little bit more, we're going to tell you how to do all that in today's video. So let's talk about what is a short-term rental. So again, by the lender's definition, a short-term rental is it's essentially divided into two categories. It can be an entire home. It can be even like an accessory dwelling, so like a guest house. It can even be an individual room inside a home. So the main thing that delineates a short-term rental between like a hotel or a longer term rental like a multifamily or an apartment is these are often rented by the night, week, or month. Again, these are important things from a lender's perspective. Long-term rental is defined generally as a 12-month lease. And again, we talk about that in another video. That's more related to an apartment or a multifamily. Um, Many lenders only lend on long-term rentals and not short-term rentals. So that's why we make this distinction. It's really important when you're going for financing that you understand how a lender is going to look at this. So who actually does write these loans? Fortunately, there are banks that will write these. So you've got your usual suspects, the local, the regional, and national banks. And then you've got a whole other category that a lot of people don't know even exists. But it's alive and well, and it's a place that we here at Capital Connection, we do a lot of our work with these alternative type lenders. They're typically national lenders. Some people call them private lenders. Some of them are not private. They're big, massive lenders. They just don't have branches, so they're not like a normal bank. But they definitely exist, and in some cases, they really know what they're doing. We'll talk about this as we go through here. But some of these lenders, it's almost all that they do is work on short-term rental loans. So it's almost like a little niche area. It's really, really interesting. Um, so let's talk about conventional first. Um, I would say conventional lender. Again, we're talking about a bank, your local bank, your regional bank, even a national bank. If they write these loans, these are typically going to be for the first time purchaser. Conventional loans typically have lower interest rates than other options, and again, these other options we're going to talk about. Um, However, they are harder to qualify for. Keep that in mind. It's kind of important. And many of these depository lenders are currently curbing lending or not lending at all. You've probably seen the news stories. We talk about them here on the channel. But again, when I talk about a depository lender, I'm talking about your local bank, anybody that's out there taking in deposits and also making loans. Uh, for a lot of them, they're experiencing some turbulence right now, or altogether they're just not lending in today's environment. This video is being recorded in November of 2023, so that's the current environment. Now we talk about alternative lenders, and these lenders are best for self-employed, best for investors that want to grow their portfolio. Alternative lenders they typically offer a faster, a smoother process with more flexible options, but at higher costs. So, the key there, I think, is faster, smoother process. And I think that goes back to the lenders that we're talking about here with alternative lenders are typically lenders that are in the space. They understand the space. In some cases, it's all they do. And this kind of short-term rental loan, it qualifies based on the property's income. Whereas the conventional lender, they're going to qualify on the borrower's income. Big difference there. So they're looking to qualify this specific property or properties, and they're looking at the income generated by the actual property, not by what the borrower can produce on their own. So how you qualify, going back to conventional, typically they're looking for anywhere between 10 and 20% down. I would say, again, in today's environment, that might be more like 20 to 30% down. I don't know. You possibly could get 10% down, but I don't personally know of anywhere where you could get 10% down as I'm recording this. Typically, you're going to need some cash reserves, anywhere between 2 to 12 months. And it depends on your credit score and your down payment in terms of how much you're going to have in reserves. This is kind of a long sentence. I'll try to summarize this. Basically, what this is saying is that they're gonna look at how much income you have globally, not from the property. So they're looking at the borrower specifically. This is a big difference between an alternative lender and a conventional lender. They're going to look at your expenses, your monthly expenses, and your income, and underwrite it the same way they do for like a home loan. If you've ever bought a home, when you go to get a mortgage, they're looking at your personal expenses. They're figuring out how much money you have, and then they're calculating if they were to make you a loan, it can't exceed more than 45% of your gross monthly income. So, and I mean your expenses. So anyway, it's just a whole different way of looking at it. And maybe this works better for some people. You have a great job, you have great income, you don't have a lot of expenses, then certainly this may be something you want to look into. They do take a little longer to close, anywhere between 60 to 120 days. I don't know if I haven't seen one take 120 days, but expect a longer closing time than you would with an alternative lender. Also plan on providing your full tax returns, a lot of income verification, documentation, letters of explanation. Like I said, they're harder to qualify for. It might feel like they're beating you up, and it's really because they're trying to make their decision based on you as the borrower versus the property's ability to produce income. Big distinction. All right, how you qualify with an alternative lender. I see that these guys typically offer more common sense underwriting. There are some lenders that we work with, and this is also huge. There are some lenders that will use comps not only from long-term rentals, but they'll also look up comps from short-term rentals. And this is something you can't find it that easily. But if you know short-term rentals, you know Airbnb properties. Most of the investors I talk to, I own a couple of these myself, and they will tell you that your income is anywhere between 3 to 5 times greater from a short-term rental than a long-term rental. It's just maybe not as consistent. It's not guaranteed. But if you're looking at it just purely from how much money can a property generate, typically a short-term rental property is going to generate more than a long-term property. So when you're qualifying for a loan, you want the comps to come from properties that are also short-term rentals, because they're typically going to show more income. And when it comes to the way they underwrite these, that means you can get more loan. You can get higher proceeds typically. So again, the income potential or the income from the property is key. Borrower credit score is used for pricing. So we make this point in other videos, but always pay attention to your personal credit score. It's really important. I think no matter what you're going to borrow in today's world, your credit score is always going to matter, even if they're using the income from the property, to determine value and loan proceeds, things like that. For when it comes to pricing and just determining overall risk of a property, they're going to look at the person standing behind the thing that's going to make the payment every month. Experience helps, but it's not required. Typically, you're going to see a 20% or greater down payment. So if you're purchasing a property, make sure you're considering that when you're going out and looking at properties. You're likely going to have to put 20% or more, maybe 25, maybe even 30. It just depends on the other, the other parts of the scenario as far as that goes. These are typically 3 to 4 week closings, and that's not an exaggeration. We can really move these along for the right property as long as we have borrower cooperation. You've got to be the one driving that. And the loans that we work here, that's typical for us, 3 to 4 weeks. Um, Here's another big one. With a conventional loan, there are limits to the number of properties you can have financed. I think it's 10 investment properties. So if you're somebody that's really wanting to grow your portfolio, or maybe you already have a big portfolio and you've outgrown the conventional lenders, you can go to these alternative style lenders, and there is no limit on the amount of properties. You can have 100 properties financed. So it's a great thing to have. And in this one, rural properties are okay. We had one not too long ago that we got approved, and the property came in designated as a rural property. I'm not saying in all cases that can be done, but it is a possibility. So if you got something out there that's a little off, and in that case, just an interesting little thing, they were doing something called midterm rentals, which I hadn't really been too familiar with up until this particular deal. But the midterm rental seems to be something that might be gaining in popularity, and it's really something like traveling nurses or migrant workers, or somebody that needs to rent a property, but not for 12 months. Maybe they only need it for 3 months, or 6 months or whatever. So if you have a property like that, or if you're looking to get into that kind of a business, maybe you live near a big hospital or whatever, this is something where you could go to an alternative lender and they will consider making the loan, again, because they don't require a 12-month lease, where a lot of lenders still do. So that's kind of a little interesting piece. How you qualify on the income. So there's an acronym. It's PITIA. I'm not going to try to say it, but it represents the costs of owning a property and in the loan itself. So PITIA is the sum of the principal, interest, taxes, insurance, and association fees. It is the way that they calculate how much loan you can get. They're trying to figure out, can the cash flow support the mortgage? So again, they're looking at how much income is coming in, or potential income's coming in. Then they're going to take away those expenses. So this all goes to the debt service coverage ratio. And that we're going to get into in another video in a little more detail. But basically, it's just a way for them to determine the new loan amount, the new payment, make sure that the income, once the income is figured out, and the expenses with the PITIA, when they use that calculation and then they plug in the new loan amount with the new payment, there has to be enough left over to cover that payment plus some extra cash, which would ultimately be cash flow back to you as the investor. So what you want to do is you want to run that calculation. Typically, it's a 1.2 or greater in the ratio. And here's just a quick example of how that would be calculated. Again, I think we're going to do another video here that goes into more detail on just specifically the debt service coverage ratio. I think it's an important thing for people to know. Investors, you need to know how to calculate this, and how a lender is going to look at this. More importantly, actually, you got to know how a lender is going to look at this. So here's the easy math. Basically, you add up the sum of the principal, interest, taxes, insurance, and any association fees. So in this example we put together here, let's say your principal and interest of this new loan that you're trying to qualify for, we figured out what the rate is, we figured out how much of a loan you need, and they've come up with a principal and interest payment. In this case, it's $1,700. Taxes are $150 a month. Insurance is $150 a month, and there are no association fees. So we have a total of $2,000 a month, right, in PITA. So PITIA, and let's say the monthly rent that we know we're going to calculate on average is $2,400. So for short-term rentals in that market, or maybe again, sometimes they may use a long-term rental comp. And in that case, let's assume that that's what they come up with as the monthly rental. You divide that rent by the PITIA, and so in this case, it's 2,400 divided by 2,000, and in this case, you get a 1.2 debt service coverage ratio. That loan would work. That loan would get approved, assuming the rest of it, was according to guidelines. So here's some pro tips, and remember, these pro tips come from many years of doing this here for our clients. We work with lots of investors here. As I mentioned, I'm an investor too, so some of these things come from my experience just as an investor as well. Um, some lenders will qualify down to a 1.0 debt service coverage ratio. That still exists, according to my knowledge, right now, even in today's turbulent times. So you're definitely going to want to shop around if you're looking for a loan. And where that really makes a big difference, if it's a 1.0 or a 1.2 or a 1.3, I've seen them as high as 1.35, I think, in the past. That just simply means that if you go down to like a 1.0 debt service coverage ratio, going back to that formula before, you would only have to, you could go to a loan total of a greater number than the 1,700 that we just quoted. What that obviously relates to then is you'll get a greater loan amount. So it helps increase your proceeds the lower the DSCR number that they're going to use for calculation. And in some cases, it actually just, there may not be a way to do the loan if they need a 1.2 or 1.25. So if they'll lower that number down to a 1.0 or a 1.1, then all of a sudden that loan might work. It might fit. So, it is worth your time to shop around to try to find the best, the best option. This is what we talk about when we're trying to find the best option for our clients. We're looking at all of these different factors because they all do matter. It's not just about the interest rate. Everyone wants to know, well, what's the interest rate? Well, the interest rate is obviously a factor, but it's not the only factor, certainly. There's many other things that go into making these loans work or not work or make sense or not make sense, so this is one of them. If your rent doesn't support a debt service coverage ratio, then a lower loan amount will often be required to satisfy that condition. Again, that's kind of what I was just saying. Comps definitely matter. Comps are so important when it comes to especially short-term rental loans. You've got to work with a lender that understands this. They're few and far between, I will tell you. But fortunately, we're aware of some here, as I mentioned. So if you can't find them on your own, give us a shout, because that is really, really a key factor to making these loans work. I found, at least in my experience. Many things will contribute to the terms of the loan. Your credit score, as we mentioned, experience is an important factor. So not to say you can't do it with no experience, but it really helps. The more experience you have, the better the deal will be. So that's just something to think about if you're just getting started. Maybe you want to team up with somebody that has some experience. If you're having a hard time getting a loan to work because you don't have the requisite experience, we always advise maybe find somebody that you can work with, that you trust, partner up with them, give up something in the beginning to get that experience, and then you can come back in and your deal literally gets better each time as you gain more and more experience. So it's really, really key. And when I say experience, generally speaking, the experience needs to show that you as an individual were on an entity that did something in the realm of what you're trying to borrow. So in other words, experience here, some people say, well, I was, a real estate agent, or I something in the industry, but the experience most lenders are looking for is that you were on the loan that was a similar style property or similar style asset. So that makes a big difference. So remember, experience is a big factor. Lesser probably of a factor, but still a factor, is liquidity. And that just means how much cash you have or cash equivalents you have once you have the loan closed. The lender does want to know that you have the wherewithal to make the payment, even if the property can't. Down payment, that's a key factor too. Most people I talk to, they don't want to put anything down, right? Everybody wants 100% financing. I'm just going to tell you, I don't think that exists. I never have. I don't know where it is. There were a few programs here and there that we were able to do some 100% stuff. In today's environment, I don't really think that's much of an option. I would just go into this thinking you're going to have to put in 20%, or again, if it's a refinance, you're probably, you need at least 20, 25% of equity there. Um, just remember that going in. If you don't have enough money for a down payment, then you're going to have to work with somebody that does, or you're going to have to figure out how to get that together. So again, I want to make that point because we get a lot of phone calls here. People call and they found this amazing property and they went to some weekend and somebody told them this is easy and they can get right in and 100% financing, blah blah blah. And we have to be the bearer of bad news in some cases, which I hate to do, because a lot of times I'll look at these properties and I'll think they're definitely winners as far as the property goes, but the individual trying to purchase it doesn't have enough money to make that happen. So I said, consider bringing on a partner. Many investors we work, this is another tip that we are saying in a lot of these videos actually, but I think it applies in the videos that we're talking about this. And so there is a program out there. It's 0% business lines of credit. Now thinking about that, 0%. So what that is it's typically an assemblage of business lines of credit. We work with a company. Their link will be below. Full disclosure, we're an affiliate with this company. If you're gonna go down this path, I highly recommend you check them out. If you're comfortable with what they can do and you think they can help you, use our link if you would. You'll get a big discount as opposed to if you go through their front door, and we get some credit there as well. So we appreciate it, and I hope this helps you. But it's 0% lines of credit, and 0%. What they do is they get like an intro rate. They're really, really good at it. I've gone through the program myself. They advertise they can get any individual, not any individual, but some individuals can get up to 250,000. So if you have a couple partners or a husband and wife, they come in, and there's a potential there to get up to 500,000 at 0%. Now it doesn't stay 0% forever. Typically it's 12 to 24 months. So it's a tool, and if used properly, it can really help people get into a property maybe that they couldn't already do because they didn't have $100,000 in their bank account ready to go to put down on a property. So check that out. I hope that's a good tip for you. So how do you get started? Like we always say, always find out what your best options are as early in the process as possible. I cannot stress this enough. Make sure you know what your options are before, again, not before you go shopping necessarily, but as early as you can. So once you've identified maybe a property, you're kicking it around, kicking the tires. Just make sure you have your arms around what you can actually borrow, or how much you're going to need to borrow, and how much money you're going to need to bring in. All these things are really critical, and make sure, in a way too, when you're talking to the lenders are great at ferreting out a good deal and a bad deal. That's one of the things I love about this process is it can actually help you as an investor determine whether or not this thing even makes sense. Because if it doesn't make sense to the lender, they're not going to issue the loan. You won't be able to do it in the first place. So they're only going to they're going to give loans on properties that will be successful, or at least set up to be successful, if that makes sense. So always consult with your bank or your lender initially. There you go. Try your bank first. I really do give this tip, I guess. as a my suggestion is you start with your bank. You start with your local bank or whoever you bank with. Talk to them first. See what options they have. Uh, Again, in today's climate, I wouldn't be shocked if they're not lending. But you may be shocked too, and maybe they are. Maybe they love short-term rentals. Um, I am aware of a bank locally that really likes them down on the coast. So that might be an option. But again, remember, it's a little tougher to qualify for them. So just go through that process. Be very thorough with them. Make sure they're thorough with you. And if you need some help, if they aren't able to help you, we do have access to these alternative lenders that I was talking about. They are going full bore right now as we speak, as I'm recording this. They're actually tapping me on the shoulder, saying, "Hey, bring us some business." So they're liquid. They're not a depository lender, as I was talking about before. They are a national lender. They do their comps, on short-term rentals. So there's a lot of things in there that we have access to that I think if you're somebody that's serious and that you really do want to grow, give us a shout and click the link, give us a little bit of information. We'll do a free evaluation and let you know if there's something we can do to help you. So I hope this has been helpful. Remember, if you can't get the money, you can't do the deal. So we started this channel really to just give free education out there, for people to. I really think this is designed for the beginners, but I don't know. It could be for people that are experienced as well, because everybody has the same challenge. And that's one thing I learned a long time ago, is that everybody, um, if you're going to be an investor, you have to. Everybody pretty much wants to borrow money. Maybe you're lucky and you got a big trust fund and you've got a bunch of cash, but you're probably not watching this video if you're that person. So anyway, if you would please subscribe to this channel. It does help us a lot. It'll help the channel grow and help us to help more people. And as I always say, if there's something else you'd like us to talk about here, let me know. We're going to try to give as much free information as we possibly can here. So I want to hear from you, what you want to hear about. So with that, I'll say thanks so much, and I will see you on the next one.